Good afternoon, everyone. Thank you for taking some time out of your day and joining us on this webinar going over the Securian SecureCare product with Tim Goh. My name is Paul Williams. I'm a Life Sales Director over here with IAMS. And before we get into this product, a few things I'd like to go over and just share with everyone about IAMS and some of the services that we offer our producers. And also, just throughout the webinar, I'll have a few polling questions that I'll pop up for a few moments, answer them if you would. And so first off, I'd like to start with our new producer bonus that we have here. It's a great opportunity. It's as soon as you get signed up and contracted here with IAMS within the first 180 days of this, as you can see on the screen, there's different levels that you can qualify for. It's great perks, incentives for cash, or if you need a website built out. If you see like the $250,000 level, that's where you would qualify for having a website built for you. And if you'd like more information about the new producer bonus, please reach out to me. It's 1-800-255-5055. All right, and we have our IAMS Business Builder program, which it's a fantastic opportunity. So as everyone may know, the best clients that you can get are referrals, and we're the same way. And as you see on the screen, if you refer somebody over to us, maybe they're not happy with our IMO, or they're just a really good fit for us and how they do business and how we do business, you get that one-time bonus, $50 referral. Then you continue to get revenue off them. So every time they sell a piece of business, as you can see on like the life target, it's 0.15% override on that. And this does not affect that producer's commissions whatsoever. It's just another way of us saying thank you. This is a great person. And I've personally seen Curtis Hawks and Steve Murray, Chris Conroy, cut $1,000 checks every quarter just for these people that you referred over doing business with us. And below that, this is a really popular program that we have here. It's our marketing reimbursement. We'll pay you $100 on marketing reimbursement for every, $100,000 in premium that you do on the annuity side, and $200 for every $100,000 of single premium, or $200 for every $10,000 of life target. And this is just a way of us, once again, saying thank you and reinvesting back into your business so you can continue to grow. And our back office support is really kind of a cornerstone of who we are and what we do. When Charles Herring founded this company 38 years ago, that was one of the things that he really wanted to drive home. And we do a fantastic job with this. And as you can see, we'll help out with case design. We'll follow up on applications for you. We usually, every 72 hours, we're reaching out to the carriers to see if they need any additional information, where we're at in the process. We'll actually scrub apps for you. We do everything we possibly can to make it as easy as possible on you, because we want you out there in front of your clients. And if you can put that back in work on us, that's what we're here for. And our IAMS website is another great resource for all the advisors out there. If you haven't signed up for the IAMS website, please reach out to me, 1-800-255-5055, and I'll be glad to help you with that process. It's super easy. Enter username, password. It'll say 24 hours for an approval. I'll just send our creative team a message and say, hey, this person just signed up, and it usually takes about 10 minutes, honestly. Now, if you're not currently contracted here with IAMS, you would need to contract with us before having access to that, and that opens it up to our sales resource library, our quote engines, and all that information there. Excuse me. And next up is our EAP solution. So, I mean, you see Firelight, that's mostly for the annuity side of the business. Then iPipeline is, for the life side, and Sunfire for health. But that's all three platforms that, we have here to, help assist you. And this right here is just an example of, some of the carriers that we have on the annuity side and the life side. And, if you want to register for it today, just take a picture of that and get signed up. All right, so our creative marketing solutions is, a really unique part of our business. They do a fantastic job with, building out logos, if you need a website built, agency solutions, all that stuff. And these are people that work in this industry daily. So they understand, what these advisors are looking for. They know content to put out there on social media for you. This isn't somebody that's just right down the road that builds websites. Like, once again, these people work in this industry daily and understand what's going on. And our wealth management side, it's something that we founded about 5 years ago. It's been a real good growth sector for us. And this is something else that, it just provides that extra layer of value to your clients. And, we've also helped people start their own IARs and, pass Series 65 test. And we've done that at a very high rate. So once again, it's just that extra added value there for your client and another area for us to add value to you. And our life and annuity sales academies, this is something that we do a few times each year. We actually have one coming up May 15th to the 17th, and just really unique opportunity to be able to get out in front of carriers and also speak with other advisors out there that, that are working and discuss ideas and marketing, sales strategies, all those things. And, it's nice just to kind of see what everybody else is doing and learning from each other. And with that being said, I'll go ahead and launch my first poll. All right, looks like all the polling is coming in, almost done. A few more people just finishing up. All right, perfect. Thank you all. And as always, like and follow us on Facebook and LinkedIn. We're constantly posting content every day to help out and just stay relevant. Great information to get out to your clients or just for you to review, whatever it may be. But that's all I have for y'all today, and I really appreciate you spending your time with me. At this point, I'm going to go ahead and turn it over to Tim, and he's going to go through the Securian product, y'all.
All right. Thank you, Paul. Let's see if I can take control of the screen here.
Absolutely.
Are we good? Can you see it?
Let's see here. Yes, I can see it on my end.
All right. Well, thank you, Paul and the team at IAMS. My name is Tim Goh. I am the Regional Vice President for our SecureCare III product. which is our long-term care solution, commonly known in the industry as a part of the asset-based long-term care category or product type. So at its core, it's a life insurance policy, but it's really meant for long-term care. And I'll get into it, but the long-term care portions of the policy are actually qualified 7702B long-term care riders. So it's a really unique product that has seen a pretty remarkable rise in interest in production. Lately, it's where the long-term care industry seems to be shifting to for a certain segment of clients. Let's see. All right. So a little bit about Securian. I won't dwell on this too long, but you may know of us as Minnesota Life or Minnesota Mutual. We've been around since 1880. We rebranded to Securian Financial, about 10 or so years ago. But we're a pretty robust financial institution, major linked benefit or asset-based long-term care player. And really the point of showing you all this is to just share, hey, look, right, we've been around for 100 plus years. In addition to long-term care, we have robust life insurance, annuities, group insurance, et cetera. So we're a very diversified company, high Comdex, high financial ratings, and we're very intentional with the products that we roll out. For those of you that are familiar with the standalone long-term care product evolution, there was a bit of a, I would say mispriced, calculation in the standalone space that caused a lot of turbulence. And we are not a stranger of that, and we are building off of that. We weren't a part of that. But for our long-term care products, we price everything, and we're very intentional with how we sell our products because we want to be around for 100 plus more years to service our policyholders. So why long-term care, right? Most of you have either experienced a long-term care event through a family member or a friend, or you've heard of it. Most retirees will need some sort of long-term care. That median annual cost will continue to go up. Right now, we're seeing it cost about $50,000 to $100,000 a year, and that's only increasing. The term that I've heard used, and I can't coin it, but my favorite term that I've heard describe this is the silver tsunami, right? The baby boomers are turning 76, 77 this year. There's going to be a wave of care that is needed from an extended care standpoint, right? 7 out of 10 seniors, 7 out of 10 seniors that will eventually need long-term care will prefer to have that care starting at home, and that will eventually evolve into facilities, which will increase costs. And why that's important to identify is that the type of long-term care product, the type of long-term care benefit is very important, right? You really have two buckets. You have reimbursement and you have cash indemnity. Reimbursement is as receipts come in, benefits get paid out. Cash indemnity is once they qualify for care, they get a cash check based off of the monthly benefit from their policy, and they can use that check however they wish. So it just adds a lot more flexibility for those that are on claim. And yes, SecureCare is a cash indemnity product. So just a little bit more of visualization for annual cost of care. We need to update this for 2024 because the new average costs have come out, and to no surprise, it's increased. The tool that I actually use to look at this, and I actually recommend everybody to take a look at, is the Genworth cost of care calculator. They were really the first ones to roll that out, and I still think it's the best tool in the industry, even though it's not Securian, but it is the best tool to really customize what the projected cost of care is per client, per area that they're in. So you can dial in per county, per town, per city, and it will tell you what the estimated cost of care will be for home health aid, assisted living, nursing home. You can customize the inflation that you anticipate that cost to go up. And you can also customize the amount of hours that the client will require for care. So as you engage in your long-term care planning discussions with your client, sometimes it's important to say, hey, look, have you started planning for long-term care? Have you anticipated this? Do you know how much it might cost? This is a good way for them to anticipate that. So overall, there are really 4 ways to pay for care. There's the self-funding, family may help out, you have Medicaid and Medicare with the government, and then you can transfer the risk with insurance. And while I'd like to be here and say, hey, look, insurance is going to cover everything in every scenario, it's likely not the case. SecureCare aside, typically a long-term care plan is going to look at some sort of combination with these. Usually it's going to be self-funding, family, and insurance. While Medicaid and Medicare are there, it's not a great solution to kind of lean on. Politics aside, in order for Medicaid to really kick in, you have to spend down assets for that. So oftentimes a lot of your clients, it's not a great situation for them to say, hey, we're just going to let the government, step in and help us in these scenarios. If that's the case, usually it happens when there's an absolute emergency. And from a self-funding standpoint, you may have that client that is in the 10 million plus net worth or even 5+ million net worth. Those are oftentimes the most at risk because, as you saw, $50,000 to $100,000 a year for cost of care on average, and that's for the average level of care. So if you have a higher net worth client that will probably want an elevated care experience, it's going to cost more. So there's no faster way for somebody to liquidate their assets from cash to investments, et cetera, to pay for something like this. And they work their whole life to retire comfortably only to see it liquidate away for an extended care situation. So transferring risk to an insurance company is really the way to go. And a lot of your clients will know that, hey, this is how they got to where they are in the first place. They're leveraging resources to really take advantage for every dollar that they have. Cool. So at a high level, right, I talked about traditional long-term care insurance standalone. They're still out there. They're still more limited. They can be budget friendly, but oftentimes the premiums aren't guaranteed and the underwriting is very strict, right? Those standalone long-term care carriers are still licking their wounds from the pricing mismatches that happened years ago. And really what you see in the marketplace now, you see all four, but it's really life insurance with accelerated benefits. So that would be like a GUL or a guaranteed IUL or VUL that has an acceleration rider that accelerates the death benefit in the event of a long-term care event. For those products, the primary objective is death benefit. It's passing on a legacy. So in order to cover for long-term care, you have to buy more death benefit, right? Annuities with long-term care and asset-based or hybrid products, you may see more and more, get more questions about them. Annuities are a great solution. They're easier to qualify. Oftentimes you can use qualified monies to fund those, but you're going to get less leverage. Oftentimes you're going to get less options because they're easier to qualify, because you're using qualified assets. And then for the asset base, traditionally they've been short pay, single premium, thus the negative tier potential opportunity cost of funding assets. But with these asset-based products, you get way more, right? You get the benefits of a life insurance policy where you get a guaranteed death benefit, where you can get a guaranteed return of premium, but it's really supercharged on the long-term care side. And premiums are always going to be guaranteed, at least for SecureCare. And this is just the potential cost of waiting. So for SecureCare, our average client is about 66-year-old. We're best price for individuals 59 to 70, and our approval rate overall as a product line is about 73, 74%. For those life insurance junkies out there, that may seem a little low, but for traditional long-term care, approval rates, this is actually quite high, right? We're underwriting for both morbidity and mortality for long-term care. So oftentimes it can be a little bit more stringent. So the ideal ages to be looking for these types of products are really in that 55 to 70 years of age, because once you get above 70, it becomes much, much harder for long-term care to be placed. And these are statistics for just industry-wide for traditional long-term care applications. Like I said, for SecureCare, our approval rate or approval percentage is sitting around 73 to 74%. So this is your classic how to fit an asset-based long-term care policy in a traditional retirement portfolio. So you may get that client that says, well, I've been saving for years and I have liquid assets put aside for an extended care event. And then you must have a conversation like, well, you know how much this could potentially cost, right? So with a policy like SecureCare, which again is going to be fully guaranteed, you're going to have a guaranteed return of premium, the guaranteed death benefit. Essentially what you do is reallocate some of those liquid assets and put it into a long-term care policy. And what that does is it really bulletproofs your practice, right? The question that you need to ask yourself and that you need to ask your client is that in the event of a long-term care situation, how are you going to pay for it? And then you can match the average cost of care and the level of care that they want. And very quickly, you'll see typically that liquid asset wedge is going to deplete very quickly. Then comes the question, well, then how are you going to pay for it? What comes next, right? Then they say, well, we may have some life insurance, we can liquidate our investments, et cetera. And you start to see this pie start to unravel. So by portioning some of those liquid assets into a long-term care policy, you can help cover the rest of their portfolio in that event. And then from a longevity standpoint for your practice, the family's going to appreciate that. The assets remain intact. And then as that policy owner perhaps passes years down the line, then at least the family then has an opportunity to work with you through that. And then you would have put a policy in place for them. So for SecureCare III, what do they get? You've heard me use the term bulletproof. They really get a bulletproof policy, or it's fully guaranteed. So they have a guaranteed cash indemnity benefit. They have a guaranteed death benefit, which is typically going to be around the premium that they put in the policy. Depending on their age, they may get a little bit more. They have 3 return of premium options, which I'll cover later on. And if they do a multi-pay policy design, so we can do single pay, 5, 7, 10, and 15 pay options. If they do a multi-pay option, we built in this guaranteed reduced paid up feature, which really makes the policy lapse proof. So if the policy owner decides to not pay premiums halfway through the policy or the premium schedule, 10 pay in year 5, they decide they can't or they don't want to pay premiums anymore, instead of the policy outright lapsing, and if they don't want to just surrender the policy, we will give them a proportionately paid up policy that they will have in perpetuity. And we have inflation options, 3% simple, 3% compound, 5% simple, 5% compound. If they have an inflation rider on that, their reduced paid up policy will continue to inflate. So really, unless they do something wacky like take a loan out of this or take a partial withdrawal, which we don't recommend for this type of policy, they're going to use it in some way or fashion. The way that the policy is structured, and this is just one example, is that the long-term care benefits are paid out between 4 and 8 years. Our most commonly used case design is 6 years. So the first 2 years of any policy design will be an acceleration. So the first long-term care dollars that will be paid out, they're actually going to be accelerated from the death benefit. But once that's depleted, we then get into just pure qualified long-term care benefit dollars in years 4 or whatever the excess years are for the policy design. And then if you add inflation like we have here, 3% compound, those are going to be pure long-term care dollars as well. So when you look at the numbers, you'll see, quite a bit of leverage. And the reason why we're doing that is because we're portioning out death benefit and long-term care dollars. Death benefit dollars are always going to be more expensive because you're underwriting for mortality. Everyone's guaranteed to die. And then long-term care dollars can be less expensive because not everybody is guaranteed to go on long-term care claim. So just a brief review of the product features. I know I touched on this just now, but like I mentioned before, we have multiple premium options, single, 5, 7, and 10, 5, 7, 10, and 15 years. 40% of all the policies that we see are single premium. Now we have 30%, which is 10 pay, and the balance is split out pretty evenly between 5, 7, and 15 years. What I don't have on the slide that I'd like to mention is that if they do choose multiple premium options like 5, 7, 10, or 15 years, they can pay monthly, quarterly, semi-annually, and not pay a modal cost, meaning that there is no additional cost for them to split up their premiums to pay monthly, right? And those premiums, again, are fully guaranteed. 3%, 5%, simple, and compound. Our most commonly used inflation option is 3% compound. That's because when you get into the 5% compound realm, the inflation is so heavy, the cost is so heavy that it actually works against the policy. So you'll see oftentimes that 3% compound is going to be the best price. So again, single pay and 10 pay are two most commonly durations, and then 3% compound inflation, most common. We have a premium waiver agreement that is available on every duration out there, so 5, 7, 10, 15 years. I believe that's unique in the asset-based world. Some carriers only offer it if they do a pay to 100. So we can offer that for every premium duration. And the cost of that is super low. It's typically less than 1%. The most I've seen it cost is around 3%. So I always recommend that if you're looking at this product, that you at least look at that waiver of premium. The potential to deduct long-term care premiums. Now, this is really interesting, right? On the very first slide, I mentioned that the long-term care aspect, the long-term care riders of this policy are qualified LTC, 7702B riders. And what that means is that you can apply the long-term care portions of the premium, which we portion out in every illustration. So you'll be able to see the premium breakdown. But the qualified long-term care portions can be applied from a tax standpoint to their advantage. The best ways that we see this used are business paid, employee owned situations. So for S Corps, the business owners are able to deduct up to their age-based limitation. And I can send out a tax guide or work with Paul to send out a tax guide after. But we see a lot of 10 pays and 61 or older. And the reason for that is because the age-based limitation for 61 plus, I believe it's like 61 up to 65. I can confirm that later. But the limitation for that is about $4,800. So if you have a business owner that does a 10 pay, $10,000 a year, they can basically deduct half of that premium because they're an S Corp owner. If you're an individual, it gets a little bit more complicated. Where it's most advantageous for non-business owners is if somebody has a robust HSA account, they can use their HSA to pay up to the age-based limitation for the qualified long-term care portions of the policy. Typically, the breakout between the life insurance premiums and the long-term care portion of the premiums is about half. So again, it says it on every illustration, and if you have any questions on that, please follow up with Paul and we can work together on getting into the details. We have a niche in our international benefits. So if somebody were to retire abroad, they don't have to come back to the US to go on claim, right? They would just send us medical records in English. And when we approve that, they will be paid up to 50% of their monthly benefit. But we don't cap the overall benefit duration, meaning that if they have a 6-year duration, right, the long-term care or benefits are paid out over 6 years, and they retire in Italy, right, they can collect up to 50% or half of their monthly benefit, but the duration basically extends from 6 years to 12 years. So that total pool isn't being reduced. It's just the amount that they can take out in any month will be reduced by half. Now, we do have a 90 calendar day elimination period. Now, this starts at the date of diagnosis, right? So when the policy owner or the insured goes to the doctor and they say, yeah, you can't perform 2 out of 6 activities of daily living, right? That is when the clock starts. So it's oftentimes a client will go, they get the news from the doctor, they're dealing with their health issues, they're dealing with their family, and they may not start that claim 2, 3, 4, 5, 6 months down the road. When they submit their claim, we'll start that clock at that date of diagnosis. So oftentimes the elimination period won't come into effect. The home modification and caregiver training. So we give $5,000 for home modification and $1,000 for caregiver training day one, or 0 days, right? They would just have to request that from our claims department. We'll pay them the $6,000 that they can use during the 90 days. That $6,000 is taken out of the very last month of the very last year that they're on claim. With basic terminal illness benefits, it's the same as most life insurance policies. And the enhanced premium payment flexibility, all that means is that we can accept a higher lump sum in the first year of the policy, and we can build out a lower level payment schedule after that. So this comes into play for 1035s. If you have a client with $30,000 or $40,000 or more or less, we can bake that into the policy and add annual payments after that to really build out that policy design. So, see, this seems to be repetitive. Sorry about that. And then issue ages. Our max issue age is 75. For the multi-pay, they have to be done paying premiums by the time they're 80, right? With the exception of the 10-pay. You can do 10 pays up to 75. Minimum face amount, 50,000. Maximum face amount is 500,000. That really depends on the policy design, so we can work around the parameters of your client. And underwriting classes are going to be accelerated, and they're going to be not as comprehensive as perhaps a traditional life insurance policy. So it's simplified issue. We have non-tobacco. Single means, they don't have a spouse. We have non-tobacco couples discount, and then we have the tobacco versions of both of those. In order to qualify for the couples discount, they have to be recognized by whatever state that they're in as being in a relationship. So domestic partnership, common law, if their states still recognize that, would all apply. We don't ask for a copy of a marriage certificate or a domestic partner's certificate, but those are the parameters that our underwriting uses to issue a non-tobacco couples or a tobacco couples discount. So return of premium. We have 3 return of premium options. Vesting means 100% return of premium. And it really just depends on the premium duration that they do. For a single pay, they get 100% ROP starting in year 6. Multi-pays, it's the year after that they're done paying. Then you have the 75% option, and then long-term care boost. This is where we get the most interest and the most questions about. Long-term care boost bases the surrender value or the return of premium value based off of a fixed guaranteed internal interest rate, right? So right now, interest rates are quite high, and day one return of premium will not beat the vesting or the 75%, but it will grow. So typically we see, depending on the age, 10, 15 plus years, that return of premium will exceed oftentimes the initial cost basis. But on the flip side of that, they get the most long-term care leverage. So around 90% of our policies right now are sold with the long-term care boost option, because the primary objective of a client, of a policy owner for SecureCare, tends to be long-term care. So they maximize long-term care, and then they sacrifice a little bit on the front end for surrender value. But given enough time at this point, that surrender value oftentimes exceeds that cost basis. And I already talked about this before with the waiver of premium. I highly recommend at least showing it, right? For linked benefit, for asset-based, it's not uncommon to see a premium waiver agreement, but it is somewhat unique to SecureCare to have it available on every option. Pricing. So right now, for asset-based, for short pay, 3% compound cash indemnity, even against reimbursement, we're the most competitively priced for 55 to 70. So you definitely want to take a look at SecureCare for both male and female. Again, for those short pay options, it's a single life policy. So our niche right now, those 55 to 70-year-olds, single life, short pay, that's where we win. Joint products, there are some joint products out there. You oftentimes will lose some leverage by going with a joint product. I wish we had a joint product because it would open up our underwriting options. So really where we come across this from a case design standpoint is if you have two clients, right? If you have a husband and a wife and both of them are healthy, so both of them will likely qualify for SecureCare or a single life policy. It is typically better for them to each have their own policy than to go with a joint product. A joint product is really advantageous if you have an unhealthy husband or unhealthy wife, but the other spouse is healthy. Then they can both get a policy. But considering the cost of care, oftentimes you will see the husband or the wife, if they go on claim before the other, will drain their benefit bucket and then will leave nothing for the others. So it typically is better to show two single pay or single life policies if they both qualify for that. This is just the male version of that. Oh, sorry. So I just showed single pay and 10 pay. If you want to see more comparisons, let us know. We have a full grid. And also, I know Paul or ourselves, we can run quotes for your specific situations. So underwriting, I mentioned before that it's a simplified underwriting process. We're never going to go out for labs. We're never going to, draw blood. It is a non-invasive underwriting process. It really consists of just a phone interview. So right now it's a phone interview for the medical part 2. So it's just a questionnaire, the medical history. If they're 56 or older, we will conduct a cognitive assessment. It's really a 30-minute memory recall. They'll be like, hey, I'm going to read you 10 words. Can you recall them to me after I'm done reading them to you? It sounds scarier than it actually is. If your client is focused, if they are in a quiet place, they typically won't have any problem with that. Now, if your client is multitasking, if they're babysitting the grandkids, if they're grocery shopping, if they're working on something else while they're doing the phone interview, it can be a bit challenging. So in preparation for your client, I always recommend, hey, sit them down, say, this is going to be a phone interview, find a quiet, focused place and do your best, right? Less than 2% of our policies are declined for cognitive impairments based off of the cognitive assessment. We're planning in early June about to launch an electronic part 2, meaning that the medical questionnaire that is taken over the phone currently will soon be able to be done online. And then if they need a cognitive assessment, they'll just do that portion over the phone. So that's really exciting because we can do an e-app, an electronic part 2, and we can do e-delivery. So if you're a fan of electronic processing, you can, in concept, from beginning to end, do a fully electronic process, minus the cognitive assessment if they need it. But if they want to do a paper app, if they want to do a phone interview, they can do that as well. The other thing I will mention here is that we will order APSs or medical records only for cause. So if you have a client go through the process, they have a few medical impairments, they're borderline, our underwriters may request medical records. We will order that. You don't have to order it. And we will only order medical records if we think that there's an opportunity to approve your client. So we're not going to waste your time on that. About 30% of all our cases require an APS. Perhaps the most important thing that I'll touch on for underwriting, and then I'll move on, is pre-screening. So I always recommend anybody with any sort of medical history to pre-screen their clients. The underwriters that are doing the pre-screens are the same underwriters that are conducting or doing the actual decision rendering. So if you have a borderline case, you can actually talk to our underwriters on the front end. Now it's going to be client diagnostic, right? You're not going to give identifying information, but you can walk through a scenario with them and they will tell you whether or not they think you should move forward with an application. We have an impairment guide. In all honesty, I don't think it's as comprehensive as it should be. So again, I always recommend, it may seem minor, but submit a pre-screen. They get returned to you in less than a day at most. And if you call them, they will typically answer within 2 to 3 minutes, if not sooner. and they will just give you a thumbs up or thumbs down. To give you a thumbs up, they're going to give you a pre-screen ID. And if you put that pre-screen ID on the application, it accelerates the underwriting on the back end. It essentially just proves that you did your due diligence, and it gives another data point for the underwriters to go off of. We're approved in all states with the exception of New York and California. And that's probably no surprise to you all if you've worked with insurance. We're anticipating having a version of SecureCare launch in California sometime in July. That product will be slightly different than SecureCare III. We'll release those details closer to the date. Paul, if you have a contingent of reps that do a lot of business in California, we can do another webinar and we can dive into pricing and competitive hotspots, et cetera. And lastly, sales idea. So it is somewhat unique to Securian where we will internally split a 1035. So what we've seen get traction is if you have somebody with a high 1035able case, right? In this case, we took a $200,000 cash value policy that's being 1035 into Securian. We can split that internally. In this case, we split it, took $120,000, we put it into SecureCare III. We took the other $80,000 and we put it into our guaranteed IUL, or Eclipse Protector 2. That Eclipse Protector 2 has a chronic illness agreement, or it's an acceleration agreement, and SecureCare III has the long-term care benefits. So what you're really doing is you're taking the $200,000 and you are turning it into about $502,503 of death benefit and close to $2 million of total long-term care benefit. And that's at age 85, right? So it's a really powerful idea if you have those clients. All of our marketing, and I apologize, this slide is not updated. It should be securian.com/SecureCare. I'll update that. But all of our marketing material is behind a non-password protected site. So as a part of the follow-up, I'll send you the correct website on this, and you can take a look at the marketing materials, but you can also reach out to Paul, and we can answer any questions that you may have. And that's it. Oh, there it is, SecureCare-tools. Does anybody have any questions?
I hadn't seen any questions come through the inbox over here just yet, but I'll definitely reach out and touch base with everyone on this to see if they do have any questions. I know I had 2 other polling questions I was going to send out. Just going to change presenter back to me. Perfect. All right. Well, no, that's all I got today. And like I said, I'll have a name list. And Tim, if you would just shoot me over that information we're talking about. So if anybody has any questions about this, I can get them the information quickly. And if anybody has any questions in the meantime, please reach out to me, 1-800-255-5055, and I'll be glad to walk through some case design, get some illustrations, product information, whatever it may be, over to you.
Awesome. Thank you so much, Paul, and thank you, everybody.
Awesome. Thanks, everybody, for joining us today.